Welcome back to the trading desk. Volatility, volatility, and more volatility. It is something that investors haven't seen in quite some time, and I know a lot of people out there are probably scratching their head and wondering what to do. Matt, what's your take on it?
Well, I will first say, preface this, that I am in fact a volatility trader. That is what I live on, and most traders live on. And I can tell you over the last 5 years, unless you've been buy and hold, it's been a difficult market, whether you're long, short, or trying to play just movement. There's a lot of ways traders make money. It's directional, or it could be, I'll take both sides of the trade and just give me the action. Give me up or down. I can make money both ways. It doesn't matter. One thing I will point out is that over the last 5 years, since shock and awe, really, the end of 02, early 03.
Shock and awe being the Iraq War.
March of 03, when we went into Afghan first, before that's the original shock and awe. But volatility has, since that time, has been at really 10-year lows. And last time we were at this level was in the 1992 to 1997 period. And in that period, we were at the same levels we were at now. We touched down to them. And when you look at this volatility index, which is an index of how puts and calls trade on the CBOE, the Chicago Board of Exchange, it's been extremely low. Over the last 3 weeks, we have now spiked up to the lower end of where we were from 1997 to 2002, which was at 25 to almost 60. So we've seen volatility back to where traders can make money and investors have some fear back in the market, which is good. Fear is good for the market because that means not everything is going up together, and it means that you can find some leverage.
Right, we've basically gone from little wiggles, traders trying to make money on little moves, to some good big moves, and it's ironic that it's happening when it is. I mean, July and August are typically the summer doldrums. Right. Guys are going on vacation, taking off to the Hamptons. They're not trading.
The last time we had a big break like this, though, was back in July of 2002, actually. So almost 5 years.
And that's that's really when we hit the second bottom of the market bottoming there. And after 9/11, we went down, and then we went down another leg in 02, as you said, and that was the final bottom. I don't think we're anywhere near a bottom, and I think we're obviously far away from the top again. It's interesting that we did top right after July 4th, again in the summer periods. One thing I'll say is my experience in hedge funds, we have always said, this is, again, summertime is a time when traders go away, but risk managers stay. And I can tell you, traders have been called back to the desk during this time and said, cut your vacation short, you've got to be back here.
Well, it's a big deal. Last week, the global markets lost $2 trillion in 1 week. Right. So it's a big deal.
Well, I think what's interesting is, we're sitting here as a group of traders, and we love this environment. It makes it great for us.
Right.
But let's look at the flip side. The tables are turned now. Last few years, we've had a hard time trying to manage a non-volatile market or a low volatility market. Now we've got investors going, what the heck just happened?
Right.
And we need to, investors are going to need to start looking at different ways to manage their investment portfolio, because it's not simply buy and hold now, because you're getting 100-plus point moves every day in the markets.
Correct.
And that's, a lot of people don't have the stomach for that.
Right. And one of the reasons I think this volatility has entered back into the market, and I think we'd like to touch on this a little bit now, is the liquidity crisis. And that changed really overnight. I mean, when I say overnight, in 2 weeks in the market, we've gone from, if you look at the credit markets and the bond markets, and I'd like you guys to touch on this a little bit, we've gone from a market where credit from the retail level all the way up to private equity on merger and acquisition level has basically disappeared.
Right.
The banks have totally restricted the capital, and that's what most people don't understand.
But previous to that, people don't understand there was a liquidity bubble. The reason real estate went up, that stocks went up, commodities went up, everything, is there was free money out there. Japan took their interest rates to 0%, basically giving money away for free.
That's, again, what you call a carry trade.
Right. Federal Reserve came out, lowered rates, in 2002, 2003 to essentially 0%. Adjusted for inflation, more free money.
Right.
You get all this free money in the system, and it goes chasing all kinds of assets. It goes chasing real estate, stocks, and everything. And so we've had this lending bubble, essentially. Proof of that is that junk bonds, the junk market grew 60% last year. That's the same as the NASDAQ grew in 1999. The junk market growing as fast as the NASDAQ.
And if you look at it like this, and a good analogy I think for people to envision in their heads is look at it as a fire hose. Okay, we had a fire going on where the hose was wide open, and they were lending to anybody who walked in the door, whether it was real estate, whether it was stocks, whether it was currencies, with the exception of the dollar. We had an entire open spigot. I mean, we were running out of water.
Yeah. For the first time in history, people could buy a house with no money down.
In 2 weeks, in the last 2 weeks, we have ratcheted it down, it's off, and it's dripping right now. Yeah. It's dripping.
All right. Well, there's no doubt we're in a different investment landscape right now. When we come back, we're going to take a break, but when we come back, we're going to talk about what some of the smart money is doing, some of the folks that you and I, or all of us, appreciate from the investment standpoint. So we're going to take a break, and when we come back, we'll get right into that.